Good morning, and thank you for joining us. I am Dale St. Clair, Chair of the Episcopal Church Foundation Finance Committee. We are beginning our first endowment session to discuss the critical element of function of strong financial leadership at any time, particularly in these historic, turbulent times that we are all living through and our church communities are living through. I am joined by the following esteemed financial service leaders and market experts: Karsten Sarek, Episcopal Church Foundation; Joanne Hansen, Church Investment Group; Bill Jarvis, Bank of America; Kevin Nichols, Morgan Stanley; and Kevin Callahan, Zevin Asset Management. As church finance leaders know, endowments can be confusing even for the savviest financial minds, and often can prove divisive for congregations and are the lifeblood of many church communities. Our thought leaders will provide guidance and direction on best practices and policies. They will offer their thoughts on how you, as finance and investment committee members, can develop strong leadership and incorporate guiding principles that build trust and confidence in the congregation and all stakeholders. Our subject matter experts will discuss the purpose of a church investment committee, the essential decisions that must be made, policy and procedures that must be reviewed, recommended that be reviewed annually. Our team will cover fundamental committee responsibilities, how to structure effective meetings, and how to touch on special topics to address throughout the year. Our goal is for you to walk away with ideas on how to ensure your endowment contributes to the vitality of your church. And we will begin with Karsten.
Good morning, everyone. I'm going to share my screen, which always causes a nanosecond delay here, but let me get my slides up. I'm hoping you can see them, right, Dale? Whoop.
Yes.
Good, wonderful. So good morning. My name is Karsten Sarek, and I am the Director of Endowment Management at the Episcopal Church Foundation. I'm going to try to turn this into a slideshow, which will work a little bit better. Let's see if I can get that going. Yes, perfect. Okay, good morning. Just a little bit about the Episcopal Church Foundation here on this slide. I'm not going to go over in detail, except to say that we invest endowment funds on behalf of over 300 different Episcopal churches and other organizations, which means that we are part of a lot of investment committee meetings. And so certainly hope to bring today a little bit of that lived experience to our conversation about effective committees. Obviously, I always like to start, and here I know I'm going first, I like to start by just giving a little bit of context and background, because I'm sure all of you coming to this session today bring a little bit different backgrounds, and I just like to make sure we've got sort of a common point of departure now for our conversation. Obviously, an endowment fund is money that's invested for the long term to support your church. The key thing there is what I've got in bold. It's intended to support your church both today and tomorrow. And it's right in there in that sort of tension, if you will, that I think is almost the main reason why an endowment or investment committee needs to be an outstanding group overseeing the funds. Endowment funds are also restricted, and I want to just break that down here a little bit carefully, because it can sometimes be the source of some confusion. They can be restricted in two different ways as to purpose, what they can be spent on: music, the building, outreach, things like that, or maybe there's no specific purpose. They can also be restricted separately as to how much you can spend from them each year. And so certainly we think of sort of a classic endowment, a true endowment, as funds set aside in perpetuity. Those are often restricted by a donor to be perpetual funds, and there's some limitations there on how much you can spend because you have to leave funds for the future as well. There are also endowment funds that a church vestry has set aside to sort of function like an endowment. They are also restricted, but they're going to be restricted by whatever policies the church puts in place for those funds rather than the law itself. So when I think most broadly here about the role of an endowment or investment committee, it's first to know what you have. And it's been interesting working at ECF. I'm always surprised, but also it's the part I almost love the most, starting with investment committees when they begin to work with us and really taking time to figure out what you have. And often records around old funds are a little bit unclear. And certainly you need to build some consensus amongst the group as to what you have. So that's important. Obviously, preserving donor intent. If a donor had in mind something for your funds, that's almost the most fundamental concept there, to be sure that you carry out. There's a state law, UPMIFA, Uniform Prudent Management of Institutional Funds Act, that's relevant there. Others will talk about that, but also some other key roles for a committee. Document your gifts, document your decisions. It's essential. And then also, more abstractly, if you will, model good stewardship. One of the most interesting things about churches and churches with endowment funds is you can also get new gifts to an endowment. In many ways, your potential donors are those members of your church coming through your doors and sitting in your pews in normal times every Sunday. And they're really watching closely what you do with the existing endowment, and that will inspire trust and confidence. Here's just an outline of fiduciary responsibilities. I'm not going to go through it in detail, except to say that obviously as an investment committee, you're overseeing somebody else's money, have these responsibilities sort of long-standing. It's a phrase that obviously gets bandied about a lot, and I'm not sure people always stop and pause and identify exactly what those responsibilities are. So just briefly, care, loyalty, and then obedience, which is kind of funny, but following really what your church mission is. You are a nonprofit with that mission. The purpose of an investment committee, we've talked about obviously understanding what you have. This is just sort of very broad brush, and I know other panelists will flesh out a lot of this. But the next two bullets there, I think, are really important to just keep in mind. You as a church, as a committee, you are the ones that know yourselves best. Any investment manager that you may hire is the one who's likely to know investments the best, though some of you will be quite expert on your own committee. But I think it's very important to know that you all have the responsibility for understanding your goals, your risk tolerance, your time horizon, very specific spending needs. Certainly talk about that with your manager for clarity and understanding, but that's in your responsibility. Ultimately, you will choose a manager and you will probably delegate a degree of management to that person. And I think it's important then to let that person carry out the strategy within the parameters that you've set. Certainly, we talk about the importance of reviewing periodically how that manager is doing, but also your own strategic decisions. Others will pick up on that. And then to be the really A+ investment committee, it's so important to think how you report about your work and communicate about the endowment with your church, not just to the vestry, but more broadly to the congregation as a whole. That's a key way towards sort of building a sense of the possibility and the import and impact of an endowment fund with an eyeball on building, getting new gifts to the endowment as well. At the outset, a committee is, of course, going to make these strategic decisions listed here, end up with an investment policy statement that Joanne Hanson will talk in great detail about in just a moment, and also most likely select an outside investment manager, which certainly we do recommend for a sense of sort of distance and avoiding a conflict of interest. Again, to be the real A+ investment committee, this is also a wonderful time to set up your gift acceptance policies so that you can also begin to think about developing new gifts to your endowment. We certainly at the Episcopal Church Foundation have sample policies we're always happy to share with anybody. Finally, I just want to pause and take a little bit more time on this slide here. So one thing that we see frequently at ECF is committees are very dutiful about meeting frequently, often on a quarterly basis. They review performance just as they should. It's all wonderful, but they often start and stop with a review of the investment returns and the performance. And that's, that's fine and that's important, but there's really a missed opportunity, we think, to begin to situate the endowment committee in the life of the church. And we encourage endowment committees to think a little bit more broadly about their role to accomplish a variety of other tasks as well. And so that also, I will say, knowing that you as a committee are going to meet quarterly to take a look at the investment returns, but also touch on other important topics, I think can help keep an investment committee away from just digging so deeply just into the quarterly returns. These are ultimately long-term funds. A long-term investment time horizon is so important, and this may help with some discipline around avoiding getting too caught up in the quarterly returns. But here are 4 different topics that you might consider adding to your quarterly meetings, perhaps 1 per quarter, and then rotating them throughout the year. Obviously, spending is one. This is the one that you probably all already are doing, and I know one of the panelists will talk at greater length about that. Certainly, the goal is to match spending with what's possible given the investments that you have selected for the endowment. You certainly need to comply with restrictions. So again, that's that understanding, the piece of understanding what you have. Certainly, we encourage spending from a quasi-endowment fund, that's that board vestry designated endowment, spending from that with the same rigor, if you will, as a true endowment, except you may have the opportunity to spend a little bit more differently. It's also nice here to have a dialogue at some point with the treasurer of the church and understand where the church budget is, church needs are. Church needs cannot drive your spending decisions. You have your own responsibilities and objectives given how you've invested. But I think it's important to have a really healthy dialogue with the church and the budget people at the church to understand ultimately these investment and endowment funds are for something. And that understanding and review and dialogue may help inform some of these other quarterly topics. So another great one to touch on each year, perhaps at a quarterly meeting, is, again, I've talked about this idea of getting new gifts to an endowment. Certainly many churches have a planned giving program. The big risk there is that there's a push of activity in one year and then they often sort of fade away. You as an investment committee may take it upon yourselves to keep the idea of developing new gifts to the endowment in the forefront of the church's mind. You might also consider very much how you report out about the endowment. That is your responsibility, and you can do it by presenting annually a chart with some numbers on it, or you could supplement that with some stories to tell about how the endowment is being used, what the impact is. That really can be something driven by you, and I think helps situate the endowment nicely over the long term in the church. Very quickly here, so I don't take too much time, very important, I think, to dedicate a meeting to training new investment committee members. So much decision making in the past just gets in people's heads. They rotate off. Certainly a hallmark of church investment committees is this rotation, and plus the fact that people are busy volunteers meeting at nights. I think having some healthy training of new committee members also presents a really nice opportunity for any church to think a little bit more expansively about who might be able to play a very meaningful role on an investment committee. It doesn't have to be the same old people. It doesn't have to be people who are investment professionals in their day jobs. Certainly, each member has to bring a level of financial acumen and attentiveness, but if you have good training, you can think a little bit more broadly about who could be on the committee, and it's a wonderful way to get newer members a little bit more involved in a very serious and important role. And finally, review of both your strategic decisions and your IPS. So many churches do the very good and hard work at the outset of setting up their IPS, but it really is a living, breathing document. And I think that others will talk more about that as well. But to make sure you do review it each year, A, for compliance, and B, to make sure it still accurately reflects what you need to do. Have there been changes at your church that need to influence how you have decided to invest? Are there strategic choices that you want to make a little bit differently? Do you now have a different understanding, for example, about your own risk tolerance? So we have found at ECF that if we can begin to work with committees to bake in this type of additional review each quarter, it can really be a wonderful way to be more impactful, more expansive, and more forward-looking about the role of the committee in the church. I'd be happy to talk at a later date with anybody. Here's some contact information. I'm going to stop sharing and now turn over to our next panelist, Joanne Hansen, who I know is going to take a closer look at the investment policy statement.
I'm not sure if I'm on the unmuted here. Karsten, can you hear me? So I'm Joanne Hansen. I'm the president of the Church Investment Group. We are an Episcopal nonprofit that works with Episcopal endowments to implement full-time investment management using what is called an outsourced chief investment officer, and to incorporate environmental, social, and governance approaches. I'd like to share with you work that we did with Trinity Church Indianapolis to update their investment policy statement, or IPS as it's called for shorthand. So I hope to create food for thought about how your church's goals integrate with the building blocks of an IPS. Our starting place at Trinity Church was discussions with the vestry, with the investment committee, with the congregation to focus and define what are Trinity Church's missions. And Trinity Church also decided that their IPS, when they updated it, would explicitly include environmental, social governance, ESG values that they were looking to incorporate in their investments. So they focused on the 5 goals that you see here. Their core work of ministry, which is the operational support for the worship, the spiritual formation, the pastoral programs of the parish. Their efforts at outreach and justice within their local community and broader communities, care of buildings and properties. I know that this is a perpetual issue for parishes and dioceses. And then specific local community investments. And I think in innovation, they also set aside a component of their endowment for future generations. So by sharing Trinity's example, I hope to encourage you to think about your goals and your values in addition to thinking about your financial objectives as you structure an IPS. So, and the investment policy statement is really your roadmap for best practices on how you manage your endowment. And this slide and the next one are really going to be a lightning round tour of IPS construction to provide you with a framework for thinking about how your investments will be implemented to reach your financial objectives, but also to further your missions. So there are 5 basic components of the IPS that are listed here. The purpose of your investment policy statement, the governance structure, investment objectives, investment guidelines, and then portfolio benchmarks to track performance. I've also referenced, as did Karsten, a spending policy. So we've touched on the first category, the purpose of your investment policy and values alignment. In Trinity Church's case, they consciously defined their missions, and they wanted to highlight the ESG values that they were including in their investment portfolio. The governance and the fiduciary responsibilities section should outline the roles of the various individuals and organizations involved in managing and supervising your endowment. It includes the people within your church, such as your investment committee, your vestry, and then the professionals involved in overseeing your endowment. And there are a variety of approaches that you might take. The church investment group works with an outsourced chief investment officer for full-time investment management. You may have an investment advisor, a consultant, for example. We'd encourage you to define those roles and responsibilities. So when you are looking at your investment objectives, it's important to tie together the investment returns that you project your endowment can earn with what your church should realistically be spending as a percentage of your endowment. So this involves the quantitative modeling that's referenced in the blue bars in the middle to project what kind of returns you can expect from the various asset classes that you've chosen to include in your portfolio. Historically, that spending rate was 5%. Given current bond rates, some parishes are shifting their spending to 4%. That's a challenging conversation about what is the appropriate amount of spending given what you anticipate your portfolio can earn. So the investment objectives also involve what kind of risk you want to take with your portfolio. So it's also prudent to think about your anticipated liquidity needs, both short-term and long-term. How are you planning for those sources of liquidity through cash, fixed income? This is intended as a future reference, not just an eye test here with all the different categories. So when you're looking, for example, at investment guidelines, how much in equities do you want to have given your risk tolerance? How much in fixed income? Do you want to consider alternative investments? Have you structured your investments in such a way that you or your investment manager can vote your proxies? How much will it cost? Are you looking at the levels of fees that you are paying? And it does surprise me when we have conversations with endowments that they don't understand the full level of the fees they may be paying. And then when you move on to having created an investment approach, you'll want to monitor and communicate the performance that your endowment has had, as well as talking about and sharing the progress to your broader mission goals with your congregation. Coming back to the work that CIG did with Trinity Church together to create a faith-based investment policy, wanted to share with you some sections that were included in Trinity's IPS. So they purposely had a section on what are our missions. Those were the things that we touched on in the first slide, that they wanted their endowment to support. Then they explicitly had a values section, which they referenced the values highlighted by the Anglican Church's Ethical Investment Advisory Committee. So that was providing a framework for then moving forward to how they were going to implement their investments. And in that category, they included both proactive criteria, looking at ESG criteria in terms of companies that have positive and proactive resource use, companies that are dealing constructively with their employees, companies that are thinking about and managing their governance process. So proactively including criteria relating to ESG investing, and then having negative screens. We don't invest in tobacco. We don't invest in firearms. They structured their portfolio in a way that it's possible to do proxy voting. So Trinity Church and CIG together see developing a faith-based IPS as a basis for a sustainable and profitable way to generate the returns that Episcopal endowments need for their various missions. And I want to just briefly touch on the fact, and we have on our website resources that demonstrate that using ESG criteria does not detract from performance portfolio. And in fact, because you're thinking about these proactive issues, because you're thinking about what's sustainable for companies going forward, ESG is, particularly in 2020, really been viewed as a contributor to performance. And that's, I think, an important consideration. Sometimes it's a conversation, I think, that goes back in time to more of the exclusionary framework versus the proactive framework. So I realize that this has been a very condensed discussion of a crucial consideration for investment committees and vestries. I'm happy to, and I believe SEEP will be sharing these slides, and I'm happy to discuss investment policy statements in more detail and to share templates. And with that, I will turn it back over.
Thank you, Joanne. I'm interjecting before it's passed to our next panelist. Please, everyone, any questions? There's a chat room at the bottom. You have access to it. It's at the bottom of your screen. We will get to those questions during our Q&A. And if there's any term that is unclear, please use the raise your hand function, which is also at the bottom of your screen. Thank you.
So I'll step in here. Our next panelist, I don't think Kevin Callahan is able to be on. He's had some technical difficulty. He's not here, is he? Okay.
Callahan's not here, so we're going to confirm at the end of our last speaker that he's not. His topic is covered and will be covered throughout each panelist, and we will make sure that everyone gets the information they expected in terms of Kevin's presentation, ESG, and the like. So we'll go to the next one. And we have a question here. I'm going to just unmute Kim. Hello, Kim. Kim, I cannot hear you. If you want to chat, oh, here you are.
Good morning. Thanks for the presentation. I just wanted to let you know the chat is disabled on Zoom. So.
Oh, I'm so glad you shared that. Well, please, Kim, thank you for raising your hand, and I will share that. Please, everyone raise their hand. We will work through this, and we have a nice core group of attendees and panelists, and thank you for letting us know, Kim.
Seems to be working now. Thanks.
Okay. So our next panelist, we're going to continue to move through. Karsten, you want to share the next panelist?
So the next panelist will be Bill Jarvis.
Perfect.
All right. Well, thank you, Karsten. You can hear me, yes?
Yes.
Good, fine.
Bill.
I do not have slides, so I'm afraid you have to look at me for a few minutes, but I do have a paper, and the paper has been uploaded to your materials. It has a little bit of a provocative name. It's called Meeting Our Better Selves. And in the church, we always try to meet our better selves, inside, outside, but this is about the kind of meeting that we've been referring to, that Karsten referred to, that Joanne referred to, investment committee review meetings. And just by way of background, I'm with Bank of America. Like our colleagues here, we are in this business. We manage about $40 billion through ourselves and our sister company, Merrill Lynch, using an outsourced chief investment office format, also integrating in many cases these environmental, social, and governance considerations, which we think are very important, Joanne, and we agree with you that there is no performance sacrifice. So this is a topic that I hope we do get into. Many of you may also know us through our predecessor name, U.S. Trust, as a trust administrator that may be making grants into your parish from trusts that we have from the 19th and 20th centuries. So it's great to be here. I'm going to focus on the paper, and the paper is basically very simple. If you're taking notes, you don't need slides. All you need to do is write down 3 questions, and they're rather provocative questions, but I'm going to explain what they are. These are questions that you should keep in your mind when you're meeting with your investment managers. And why is this? Karsten referred to this. We've had this probably as a part of your lived experience, that on a quarterly basis or a semi-annual basis, you either before our current lockdown situation would have had a meeting with your investment manager, and the investment manager would bring into the meeting or would send you a big thick book full of numbers and small data on pages and so on. And they would go through it, and even with the best will in the world, they would be speaking investment speak. They would be talking about a certain vocabulary. And for those of you who are in this business, that's great and you can understand it. But for those of you who are lay people, who are perhaps more mission oriented, it might have been a little bit bewildering. And this leads to, I don't want to use the word pathology, but meetings that are sort of substandard. They don't achieve what they could achieve. And Karsten, you very capably referred to in your slides some other things that meetings could be having on the agenda. This is where we're going to go. So here are the 3 questions. Very simple. First question that you asked your investment manager, it's in lay people's terms, what did you do with our money and why? What did you do with our money and why? We'll talk about what that means in a second. Let me give you the second question. The second question is, what happened then and why? The third question is, what are you going to do next and why? So this is a kind of armature off of which you can hang not only the review meeting itself, but actually a very productive discussion about what the endowment is for. Let's start now, because these are questions. First of all, what did you do with our money and why is about the past and your intentions and actions. What happened then and why is about the fate of those actions. How have we brought us to this point? And then, of course, what are you going to do next and why is what will we do in the future? So when you ask, what did you do with our money and why, you're really asking a deep question that every investment manager should be able to answer. And when you think about this, here's another way to take an easy note. I want you to put on your piece of paper 4 P's, P, 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 P. Because every investment manager should be able to answer, first P, what is their investment philosophy? And this means, how do they believe that excess return is generated in the world? If you're a pure investor in index funds, you believe that there is no way to generate excess return. But if you're believing in a manager that allocates among funds, even though those may be index funds, or if you're a manager that is actively managing, there is a philosophy there, and you need to find out what that is, and you need to find out whether you actually can adopt that or not, whether you can walk around and say to your fellow parishioners, yes, this is what our manager does, this is what they believe, and by the way, we hired them because we believe it too. The second P is process. So once they've stated how they believe or what they believe is the way in which excess value can be extracted from the market on the behalf of the parish or the diocese, how are they going to do that? What is that process? And it should be rigorous, it should be replicable, it should be transparent. If someone says, oh, it's a proprietary process, we really can't tell you, yellow lights should start flashing. It's one thing to have skill, it's one thing to have proprietary systems, but they should be able in a transparent way to say, this is what we believe as to how value is to be extracted, excess value, and this is the process that we're going to use to do it on your behalf. The third P is people. Who are the individuals who are going to be doing this? So there are designations in this world, the equivalent of PhDs. Dale, you have a CFA designation, Chartered Financial Analyst designation, some of the others on this call too. Kevin, I can't remember whether you do as well. This is kind of a very rigorous program that people have to go through. And there are other designations as well, not just CFA, but who are the people? What are their qualifications? And importantly, to come to the point that we always want to refer to, what is their integrity? What is their background? What have they done? Who are they as people? What kind of life do they live with the money that they're making as fees off of what they're doing for you? And then finally, the fourth P is the one that many of us would put first, but here it actually comes out of the other P's. It's performance, investment performance. So if you have a philosophy that is rigorous, if it is implemented in a consistent way by a process that is repeatable and transparent, by people who have skill and integrity, the performance will probably come right over the long term. Maybe not every single quarter, maybe not every single year, but this is the way investment management works. So what did you do with our money and why comes down to these 4 Ps, and then you graduate from that to an acknowledgement of the purpose for which the endowment exists. Karsten, thank you for bringing that up, and Joanne. Reaffirmation of the investment philosophy as embedded in this investment policy statement that we've been talking about. And then finally, since we're talking about what did you do, a statement of any changes that were made to the portfolio since the previous meeting. So what did you do with our money and why? So this should be fairly simple. We did this with your money because we have a philosophy about investment. We did it using this process, and these are the people who execute it. And this is what now comes to our second question. What happened then and why? And so every army goes to war with the people and equipment and geographic proximity that it has. And the same is true with investing. You go into this battle to try to extract excess return with the skills that you have, the skills that your manager has, and then history intervenes. This happened a year ago. We saw history intervening in the pandemic in a way that no one had planned for or expected, practically speaking, in a way that radically affected every single one of your endowments and that needed the intervention of outside forces, strong government support, strong central bank support, prudence on the part of the investment managers. Certainly, I'm sure all of us did that. We certainly did, to react to those circumstances. So even if it's not an extreme circumstance, you're probably going to come to a situation where sometime in the course of the year, when you say what happened then and why, an honest investment manager will say, this portfolio is structured in such a way as to take advantage of this and that and the other thing. These things were favorably positioned, and look, we made money for you. These things were positioned, and unfortunately, the market or politics or the world went in another way, and at least temporarily, we didn't have the results that we had. So this is where you as a vestry committee begin to become co-owners of those decisions, right? It's not just what you were trying to do, it's what then happened and why it happened. So again, when you're going into at coffee hour after communion, right? You're talking with someone and they know you're on the committee and they say, wow, you know, the markets are not great. How are we doing? And you're able to say, well, the portfolio had a couple of bumps on this area because we're invested here to take advantage of these things. Remember, philosophy and process. But we had advantages in this area, and on the balance, we think we're doing the right thing. So that ability to talk in lay people's terms to your parishioners, very, very important. So here, as I said, we're understanding the circumstances where the strategy that you've got will work as intended and differentiate it from those where it doesn't. Secondly, to discern how these economic, political, social, other factors that prevailed were aligned with or differed from what was expected. And then also, of course, you as customers, as clients, are assessing and reviewing the behavior of that service provider as they answer these questions. How are they doing? How are they able to talk about what they did in a transparent and honest way? So this what happened also has to be accompanied, as I always say in the questions, by a why. So sometimes bad things happen to good endowments, right? With the best intentions in the world, but it's that why. What were you trying to do? Why were you trying to do it? Were we all here on the same ship traveling together, intellectually speaking? And if we were, then we become co-owners of these processes and these decisions, which is really a very strong position for you to be in. So having been through that, this third question, what are you going to do next and why, of course, is about the future, ascertaining not only the effect that the events have had on the thinking of your fiduciaries and the service provider. Do you going to make some changes or not? Do you think that this is a temporary bump and we don't really need to do anything else and we can continue as we were? Or do you think, this is something that's relatively permanent, or actually the penalty is too great for us to bear, we're going to make some changes? And whether these strategic or tactical measures are appropriate. So when reality intrudes on a plan, as we say, you want to take a look at the plan, take a look at its intersection with reality, and see how that possibly might be changed or prudently adjusted going forward. So when we're doing this, this then cranks back into Joanne's, Karsten's, Dale's, Kevin's points about governance. Governance is the overall process through which these steps are implemented. And the more relevant point here is, how are you going to structure your meetings so that they incorporate these questions, if not explicitly, implicitly, number one. And number two, to the point that Karsten and Joanne made earlier, that you onboard new members of your investment or endowment committee or finance committee so that they understand as they come on that this is the way we do things. This process has integrity, it works, it gets the answers out that we need, that they're not coming in because, of course, these people tend to be often capable, very sophisticated, often in finance, here to make some changes. No, we've got a good process. Let's work through this rather than try to blow up something that was working pretty well. So they can also be used, frankly, looking forward as part of the manager hiring process in the event that you do decide to go out and have a request for proposals, so-called RFP. So candidates might be asked how they might respond to one of the three questions using a hypothetical or a historical scenario. They might also be asked how comfortable they'd be in adopting this type of review meeting to their own processes. So this is something where you as a committee member, as a representative, not only of the living people in your parish, but of the faithful who have gone before, and also of the unborn generations who will benefit potentially from the work that you're doing now, can stand at that pivotal position and with integrity and rigor represent that long view that Karsten referred to as the representative position of the endowment. Perhaps I'll stop here and see if our re-enabled chat gives us any questions, or maybe hand it back to Karsten for the next step.
I think, thank you, Bill. That's fantastic remarks. We do have a number of questions, but I'd like for Kevin to begin his presentation.
Great. Absolutely.
We can coordinate all the questions and have a healthy dialogue. So Kevin, thank you and welcome.
Great, thank you, Dale. Can everyone hear me okay? Is this all right?
Yes.
All right, wonderful, wonderful. Well, listen, I just want to say, this has just been a fantastic panel so far. The information and, questions, topics, how to manage the meetings. This is all really great information that I'm hoping a lot of the, people listening in this panel are just going to take back with them. I've certainly learned a lot thus far already. By way of background, my name is Kevin Nichols. I work for Morgan Stanley Consulting Group and Institutional Services. We manage about $300 billion of institutional assets at our firm, 30 billion specifically with nonprofits that include religious organizations. And I'm going to be talking about cash flow needs, kind of special projects, how this all incorporates with the IPS. And I'll be sharing a slide to demonstrate how cash flow is really of paramount importance to supporting your organization. So a lot of our panelists have kind of talked about this previously, which is, you always want to start with what is the mission of the endowment, or what is the mission of your organization. The mission really should reflect, obviously, your values, okay? The purpose of the endowment, and the fact that it's there to support the operations of your organization into perpetuity. Okay, it's not there to try to take advantage of something that's in the market that's going on today. It has to be able to ride multiple market cycles, ups and downs, different economic challenges, a pandemic like we're all in right now, things to make sure that you're going to support this for a very, very long time. So it's not there to beat a benchmark, okay? It's not there to beat a market benchmark. It's not there to, generate alpha or excess return or any of these other, fancy financial words that some of your consultants might come in and do. It's not there specifically to focus on performance. It's there to provide cash flow to help the organization continue on in times of challenging situations. So one of the things, obviously, that is really married with that is the spending rate. What is the right spending rate? And one of the panelists before said, it used to be 5%. Now with everything, interest rates being there, are a lot of them are going down to 4%. But the net of it is that, you should be able to run Monte Carlo analysis or scenario analysis to give you a sense of what is the right level of spending given where the endowment is. One of my colleagues, Joseph Matthews, is going to be presenting later on in this conference, Morgan Stanley's Wealth Desk platform, which kind of goes through a few of these things, feeds in our capital market assumptions, and kind of can give you different ranges of outcomes depending on your level of spending. So this is something that we do for our clients. And you can see that obviously as the spending level increases, the chances of the money, keeping surviving on and providing on in perpetuity decreases and decreases and decreases. So communicating that to your investment committees, communicating that to your members becomes extremely important. Members will sometimes look at the endowment of your organization and say, well, you have, X million in the endowment. What's the problem? We have plenty of money. There's nothing to worry about. But they have to get the sense of, how the markets can change, how the spending needs can change, how the needs of the organization can change at a moment's notice, and that, inflation expectations can change. Inflation's been very, very low. We know that can change at a moment's notice as well. Interest rates have been increasing the last, few weeks. So our institution provides a big emphasis on secure, reliable, and growing cash flows, okay? Because those are the things that are going to support your endowment and support your organization no matter what's going on. What we want to do is provide the endowment as a source of strength in times of need, as opposed to something that is weak and that cannot provide when the economy and the markets take a turn for the worse. So I'm going to share my screen right now. Here we go. Let's see if I can get this. Apologies, it's blocking me from doing so right now. Of course. Just give me a second here.
Kevin, I will ping the control room and see if they can help.
It says I have to open system preferences, security and privacy to grant access. I am very, I apologize for this.
If you would like to, if you would like to email them to me, I can try and share. If that's a quick fix. If not, we can do it.
That's very kind of you. Let me see if I can, hold on here. I think I might have it. Let's see here. Okay, I'm just going to power through here because having some technical difficulties, I apologize. But the net of it is that what you want to focus on when you're going through these reviews is you want to try to focus on money-weighted rate of return, okay? Because that's what actually happened to your money. Bill had kind of spoken about this before, the 3 questions that he had. Time-weighted rate of return is important because it's good to evaluate a manager on what their time-weighted rate of return is and how they perform during a specific section. But money-weighted is really important in the fact of what actually happened to your money at the end of the day. And when you're looking at strategies, okay, that mirror obviously equities and fixed income, and we have very low fixed income yields right now, part of a lot of the heavy lifting or heavy cash flow has to be done by the stock portion of your portfolio. So how do you do that? Given that, in this past year, energy companies, airlines, restaurants, all cut or eliminated their dividends. Well, you want to be with managers that are searching for financial strength within the market and are finding companies that not only have security in their dividend, but are raising their dividends much faster than inflation. Just in the last, I mean, in the height of the pandemic, you had both Procter & Gamble and Johnson & Johnson raise their dividends by over 6%. I mean, you couldn't even, have guessed this when everything was going on. And the net of it is that if you look at a 5% spending level, okay, and if you started back in 2001 and you had a 5% spending level on your endowment, okay, and you had a 3% increase in those in the spending level over time, okay, by the end of last year, if you had invested in an S&P 500 index fund, okay, for every $100,000 that you had, you would have ended up with $100,815. Okay, and this is with spending 5% of the funds every year and growing that by 3%. So it's a net spending of about $123,000, almost $123,500. But you would have ended up with $100,815 in your fund. So you were able to spend, but you weren't able to grow the kind of the corpus or the principle of the endowment. If you had focused on and this is obviously in during two market collapses, but during times where the market, the S&P 500 especially, was reaching all-time highs for a majority of the years that we're talking about here in the last 20 years. If you're focused on an active manager that had a 5% cash flow, target, couldn't always meet that because cash flows, yields are dependent on the price of the stock and the fluctuation of the stock. The higher the price goes, the lower the yield goes, and vice versa. And had been trying to grow that cash flow through secure, reliable, and growing companies that are secure, have secure low debt loads, very focused on increasing the dividend. You would have spent that same $123,500, but you would have ended up with $180,000 per $100,000. So you would have grown your corpus by 80% as opposed to keeping it flat. So even though there's a big debate about active passive, and that's a whole other topic that we certainly can get into. Security sometimes comes in the most surprising forms, and security can come from the cash flow that you're receiving from the stock portion of your portfolio. Because one of the other factors that's happened in the last 20 years is the bond index. Okay, everyone saw, every single maturity along the Treasury curve was under 1% a year ago in March of 2020. Under 1%. 30-year bonds were yielding under 1% per year. That is not even going to keep up with inflation. That's going to be extreme amount of interest rate risk, extreme amount of duration risk, and interest rates have been falling for the last 40 years. If you started with that same $100,000 and spent $5,000 out of your bond index, you'd be left with only $57,000 today, and at a much, much lower yield. So what has this perpetuated? Well, one is a lot of people have been enticed from returns in technology stocks, Apple, Amazon, Google, Netflix. They've done fantastic, right? They don't provide a lot of cash flow though. And historically, they've been very, very volatile. So some of the risk taking that's happened in the portfolios is unwanted given the needs of the organization. So you have to kind of bring that back into focus. That usually starts in discussions about the risks that you want to take and the types of investments and the types of managers you want to have in the portfolio. But the net of it is that if you're focused on cash flow, secure, reliable, and growing cash flow, those are the things I want you to remember. That will provide the support of your organization in bad markets and in good markets. And the kind of the added benefit that you get from securing the cash flow from your endowment is in bad markets, they usually tend to perform much better than the market indices, which means over time, you're smoothing out the returns. And with that, I'll open it up to any questions. Thank you for offering to help, Karsten, too. I just, it's going to have to send an email and do whatever. So
Well,
I can provide the piece to anyone who's willing to, wants to see it.
good. Go ahead, Dan.
Thank you, Kevin. We've had a number of requests, frankly, for everyone's slides. So Kevin Nichols, that includes you and everyone else. I know one good way is to have your presentations in the bios on the app enabled, but Karsten, I know you're getting that request as well for slides.
Well, I also just want to mention that we have our other speaker who we skipped temporarily, Kevin Callahan, I believe is now on the phone. Kevin, are you on the phone?
I actually just enabled him through the David in the control room to join us as well. So I'm one of the two. I'm excited that he's here. And it looks like David enabled him on the phone, but we can't see him, at least not yet, but at least he can share his remarks.
So if he can talk, I have his slides and can share those. So if Kevin is ready to present, we could do that if he's here.
Okay. Yeah, I'm getting confirmation that he is, if you have him on the phone, because he's no longer, I understand that, and he'll speak to this, he has spotty Wi-Fi. So he was actually enabled, and now he's not with us virtually, but the phone, God bless the phone. We've been using it for a real long time, long before all of us were born. That can work too. So Karsten, I'm going to pass it to you and to see if we can get Kevin Callahan that way.
He's not on my phone. I thought he was able to dial in to the conference and join the conference by audio only, and I would share the slides, but it sounds like that's not going to work.
Okay, so what I'm going to do is I'm going to open the, there's a question for everyone, and then I'm going to try and work with the control room again to enable Kevin Callahan. A really important question that I know, well, so first of all, we have questions in the chat room, and then I have 7 questions prior to our beginning at 11 a.m. Eastern today related to this panel. And I know that Kevin Callahan was going to address some of this, so I'm going to open this up while I try and get him in here as well. And that is the topic of ESG, sustainable investments. Our panel here are veteran financial experts, and ESG has been with us long before we were born. And it's exciting where the world and the investment industry has morphed to. There is a long-standing concern about the value of ESG and fiduciary responsibilities and how that correlates with returns. But I am going to open that question up to the panel because I know everyone can address that in different ways and in relevant ways for us now. And Karsten, let me pass it to you first, and we can go around while I try and see if I can help Kevin Callahan get it in some way.
Sure, thank you, Dale. So we at the Episcopal Church Foundation do talk extensively with churches about socially responsible investing. And we have I think one of the most interesting conversations that we have is churches really they wrestle with what they need to do internally at their own church to meet their goals, understand where the congregation is, but also very interested in complying with guidelines, guidance coming out of the Episcopal Church itself. And so I'll just touch on a couple of themes there. Certainly, I think there's a sense that, way back, socially responsible investing involved screening out certain companies. Tobacco companies certainly often the target there, along with others. Certainly, the Episcopal Church also now today is increasingly embracing the sense that engaging with companies through your investments to encourage positive behavior and certainly using proxies if need be to do so, but engagement is just as important a form of socially responsible investing as is screening out, along with this idea that embracing environmental, social, and governance considerations, ESG considerations, is also a very fine way to approach socially responsible investing instead of, again, sort of an older school interpretation of just screening out certain, say, sin companies, although I don't actually really like that phrase myself. So that's often where we start in our dialogue with churches. We offer several options, but it's interesting how people are often looking for guidance and a sense of, we need to do something, we should do something, or certain members of my congregation are really asking, and it's a very fruitful place for a conversation about what goals are and where the industry is headed before starting to make some very specific choices for your own portfolio. With that, I know that Joanne certainly also works in this area, and I'll turn to her for a little bit more.
Joanne and Bill and Kevin, I mean, everyone does, and which is great. Joanne, please begin.
So I would actually flip the question on its head when you are thinking about this. And we really view ESG as a risk mitigator, because think about this, you're looking to make long-term investments. How are those companies positioned vis-a-vis the various challenges that the world is facing? Climate change, the pandemic brought out a variety of issues about how companies treat their employees and were able to cope with this crisis. And fundamental governance. I mean, you've seen companies like Equifax, who had privacy issues, trip and fall on governance. ESG, the ratings, MSCI's ratings, warned about Equifax, and so we weren't invested in that company. And so we really view it as, these are fundamental building blocks of selecting and investing in sustainable companies for the long term. So it's a risk mitigator, and it's additive, because these are companies, for example, when we analyze our portfolio, we're looking at the transition initiative pathway, which is a structure to say, are the companies thinking about these issues? How are they planning to integrate this into their operations? So I really would pose that question when people are thinking about ESG, to understand that it is looking at viable, sustainable companies moving forward in your portfolio. The Church Investment Group is a Principles of Responsible Investing signatory, UNPRI. And part of that process is engagement, looking at how companies are reacting to these various challenges. And the Church Center has done great work in this area. And so we have structured our investments in a way that we can vote in alignment with the guidance of the Church Center on proxies. I mean, as you may know, if you're holding mutual funds, if you're holding an index, you're going to be reliant upon the investment manager to express your proxy voting preferences. And so we do think it's an important part of that engagement piece, that you're actually structured in such a way that you can vote and move those corporations forward. So I think for us, it's important to think about the fact that environmental social governance is a process. It's not supposed to be a product that someone lifts off a shelf and says, here's this product. It really is supposed to inform the way that you think about your investments, that your investment manager thinks about your investments, so that you have sustainable companies going forward. And with that, I will turn and let my colleagues share their perspective.
I am, before Bill and Kevin jump in on this question, and I know they're prepared to, I do want to add a question that both of you gentlemen, I think everyone can answer, but please incorporate this question that we have on this topic. as you expound on it. And that is, the question is, we are interested in a positive screening for social justice inclined companies. This is beyond ESG. How do we think about adding this tilt to our portfolio? And I have a thought on that as well, but I'm going to pass it to the panelists. I want to make sure they get in their remarks. And Kevin or Bill, which one of you would like to go first? And then we can go back to Karsten and Joanne as needed.
Kevin, why don't you go first?
Kevin, would you like to?
Yeah, thank you, Bill.
If you have a response to this question as well.
Well, I can just say that Morgan Stanley has an Institute for Sustainable Investing. We've had this for about 6 or 7 years now, and it looks at not only including things like social justice, minority-owned businesses, women-owned businesses, but also can get as refined as how do you invest in companies that support your local community. And so, I would just say that, I'm happy to provide more information on that, to whoever asked that question. We can kind of get into the weeds about that, but it's very customizable, it's bespoke, and it can be really, tailored down to, we had a situation where a nonprofit in Southeastern Connecticut wanted to align their endowment with companies that were really, supporting the local community. And we were able to find, investments and things that, aligned exactly with what they wanted. Companies in the area, companies that were giving back to the community. And so I would just say that whatever your, inclusions, exclusions, whatever they may be, I think that the growth of ESG and the growth of SRI type investments has shown that we can find something to accommodate and to implement in your endowment.
Thank you, Kevin. And I'll just add, ESG speaks directly to the environment and the social justice and sustainability. These are words and definitions that are being incorporated into our conversations, which is fantastic. And it is expounding and broadening the scope of, frankly, the foundation that was already existed. And many institutions like Morgan Stanley and Bank of America and others are actively addressing them in a variety of ways. Bill, would you like to say anything on this?
Sure. I'm not going to quote. You can go to our website. We've invested over $1 billion in issues relating to racial justice in our firm and in our communities, and that's just accelerating things that we've already begun. In addition to other, not only grant making in local communities, but to your point, looking for this social justice aspect for inclined companies. I would like to, if I can, just pull together the things that have been said. And I'm speaking now to those of you on the line or here with us who are thinking this is all just another flavor of exclusionary investing. I'm going to put my fiduciary duty at risk. It's going to underperform. You've heard a couple of us refer, and we at our firm as well, have funds with very good track records that pursue ESG that have actually outperformed. Not just in short periods, but longer periods. And I'm not going to talk about specific products here. I think we all can agree that this is a fight that has been won. And here is the reason why. And this is what I want you to take away. When you think about environmental, social, and governance investing, of course, we can think about viewing it through this values or mission or spiritual oriented lens in which you want to invest in companies that do these good things. But even if you take that values or mission or spiritual part out and just approach it from an agnostic security analyst point of view, as between two companies, you're probably going to want to invest in the one that's better at environmental compliance. You're probably going to want to invest in the one that's a better employer in its community. You're probably going to want to invest in the one that has better and more transparent governance, because those companies are likely to be better run and they're likely to outperform over time. Now, one thing we do see in ESG investing with these longer term outperformances is these companies, in order to do these things, have to be better resourced. And so they tend to be larger companies. So there's a kind of large cap little bias sitting in successful ESG funds, but that's not destiny. Any company can choose to do this. It depends on how it chooses to allocate its resources. So for those of you who are thinking that this is an automatic risk to fiduciary duty, 2 points. First of all, you can demonstrate that it's not, and all of us through our firms and the products that we have can do that. But secondly, even if you want to take off your church values hat and put just an agnostic investor hat on, this is also something that bears very close watching. And that is why ESG investing is now being taught in chartered financial analyst courses, what I referred to earlier. And I think there's a pretty good bet that if you look at ESG in 15 years, it will no longer be a separately talked about thing. It's being integrated into mainstream security analysis. Certainly all of our, we manage close to $3 trillion when you include everything that we do at the firm through our chief investment office. And our entire due diligence apparatus for managers, for companies and so on is now integrating ESG. So this is becoming part of the mainstream. And I would encourage you to think about that and behoove you to consider thinking about how you integrate it into your parish endowment considerations.
Thank you, Bill, for that information. I'm going to pass it to Karsten and Joanne for comments. And I'd like to say, I'm so glad you brought up some of these key points. Some of you know that I started my career in 1991 as an asset owner at the New York City Controller's Office back when the word SEN stocks were used. And the New York City Controller, I designed the first emerging manager program in the Controller's Office, and now that is also a relatively common term. Typically, emerging managers are women and minority-owned firms. They're firms of all types in terms of genders. And consultants now have universes that speak to a performance matrix with these specific firms, along with the PIMCOs and the Fidelities of the world. So the good news is peer universes, everyone's equal, and peer universes across asset classes include large firms and small firms, and the numbers will always tell what the results are. So behind the research, there are small firms that may be experts in areas such specific to ESG, and your consultant will share those information with you, and it's all back to the investment policy statement in the matrix and the measurements for all firms in every asset class. Karsten, I'm going to pass it to you for further remarks.
Sure. So I just wanted to make one quick comment, because obviously people have talked about the language, the verbiage, the different approaches that different managers use, and also as things evolve. At the Episcopal Church Foundation, our investment manager for our endowment program is State Street Global Advisors. One thing that they have done recently is really within the G or governance component of ESG, they've really highlighted and elevated various issues of racial equity inside what they are evaluating and measuring as they look at all of the G or governance factors. And so that may not be a separate screen, but it's a amplification and review and modification of the most essential components of the G or governance feature. So also of interest, and I'll move on to others. Dale, I'll let you direct.
Joanne?
I think an interesting resource that people can go refer to is a group called Just Capital, and they look at and rate various companies on this issue and a variety of issues. So I think they're an interesting independent source that you can go to. And I also think it's fair to ask your investment manager, how are you internally walking the walk? What sort of employee, what's your diversity within your company? How are you looking at the supply chains in your company? it's the same kind of questions that should be applied to the external companies in which they're investing. So to take a look at the firm itself and how they are engaging on this very important topic.
And along those lines, Karsten referenced the RFP. There's also another in sourcing for third-party advisors is also an RFI, request for information. But to Joanne's point, asking the questions and understanding from the whole committee, what's important, what's your purpose. There are templates. And I know all of our panelists have templates in terms of RFPs and RFIs, and Karsten in particular, since I'm with I've seen hers, but I know Joanne and others have them. These are important questions, important thoughts, and I'm glad that there's more intelligence now to share with everyone to make sure that they're addressed and integrated throughout church communities. Another topic that is, and I'm trying to weave several questions into one big one, is technology. And I am so glad that we've had a number of people bring this up. Technology has, 2020 in particular, has accelerated everyone's use of technology, albeit all of our churches and institutions have been marching this way for a long time. For the last 4 years, I've spent a lot of time myself in new technologies and emerging technologies, but I'd like to open to the panelists on how technology has impacted endowments and best practices and share as others or church communities are trying to come up to speed. This is information that can be shared. This is an open question to all of the panelists, and I'd love to step back and hear what let others share. Understood.
I'll just say the obvious. I mean, we're
okay.
here, right? So your point about the acceleration, so many things that had been thought of as things that would evolve over the next decade have come in the last 12 to 18 months, right? And aren't going to go away. So this kind of experience, perhaps for manager review meetings, not every single one, but maybe some of them in the course of a year. Certainly the use of technology, one thing that we've observed because we work with so many hospitals and healthcare organizations, telemedicine, something that was viewed as rather quaint and interesting and sort of a sideline that might come along. But probably many of you on the call have seen a healthcare provider remotely in the last year. And having made the investment, the organizations are not likely to put it aside lightly because it is a big saver of cost, and cost drivers through the healthcare system are very important. Those are just two examples. I mean, one could go on. I wonder from the point of view, though, of church, and this is the intersection of finance and mission. For many of us, going to church, right, is a nice thing. We're here because we like going to church, right? We like being Episcopalians. We like the whole thing. And not to have been able to do that in 3 dimensions for the last year has been a real stress. And so the question, having made the investment that many parishes and dioceses have made in the ability to project services, not only Sunday services, but other types of things remotely, once that's a sunk cost, will there always be the ability to sit there on Sunday in your pajamas with your kids in your lap and attend communion virtually? I don't know, but I know a lot of vestries that are thinking about this. So maybe those are just a couple of ways of answering your question.
Many churches are thinking, as companies are thinking about hybrid environments given the experience in 2020. And I'll just add the obvious that only works when you have Wi-Fi. And Wi-Fi is not available to everyone, obviously for a host of reasons, economic reasons, location reasons. Even one of our panelists is having challenging issues. So these are questions that we will continue as a church community to address in our churches. And I know there's multiple ways to let others know what other churches are doing to address this in their specific communities. I'd like to move to another question. Again, this is a combination of questions. What is the relationship between the endowment board and the vestry, and what and also is it independent from the vestry, and what are best practices between the endowment and the vestry? And that's an open question to anyone on the panel who would like to address that.
I just start for 1 second there and move on to others, because certainly this is a topic for everyone. But ultimately, a vestry has the primary responsibility for overseeing endowment funds. They delegate responsibility to an investment committee or endowment committee. The terms are interchangeable. Certainly, I think there should be clarity around what is in fact delegated. And then, of course, outstanding reporting back. We've talked about that at the beginning, reporting back to the vestry about the decisions that the committee has made. Often, obviously, something primary like the strategic goals and the IPS do need to be approved by the vestry. And then on subsequent issues, the endowment committee is often then making recommendations with their expertise, knowledge, deep dive recommendations to the vestry around things like spending, where honestly it's most likely that the vestry will understand that the endowment committee has had the experience and done the research. So that's the overall structure. I really would consider it sort of teamwork with an enormous amount of transparency and trust. One thing that's interesting that we see is from time to time, a church will set up an independent body to oversee an endowment. Perhaps endowment is formally in its own nonprofit corporation with its own board of directors. I know people have differences of opinion over that. If you are in that type of situation, we tend actually not at ECF not to recommend that, but that it often is the way it is. But I think the most key thing is to make sure that any kind of independent board and the vestry, the church leaders, have a unity of purpose over what the endowment is intended for. And you don't want to end up with people heading in different directions, which is probably at the end of the day really a result of poor communication, miscommunication opportunities, rather than a true difference in direction. But the other thing I'll touch on for just a second is that some organizations set up an independent body way back out of concern that there would be, otherwise, that was the only way to protect the funds in the endowment. And nowadays, with laws in place, the Uniform Prudent Management of Institutional Funds Act and whatnot in place, there is ample protection built into the law, and then with any sort of good policy guidelines the church puts into place. So this fear of misuse, I think, is best directed today, if you're starting afresh, by having good policies rather than by having an independent body. So that's a nutshell from me, and I'll stop there and turn it over to others.
If I could just say, that was part of my conversation, was to think about how you're going to define those various roles, and it varies significantly by the parish own situation. I mean, you will find, for example, in urban areas, New York, a Boston, you can have an investment committee that's comprised of a significant number of investment professionals, but we certainly have worked with parishes that have few, or we've worked with Episcopal monks who have none. And so there is variability in the question of who is your congregation and what are their skill sets. As Karsten suggested, I think it is a good idea to have an investment committee if you have an endowment that is overseeing that. But that communication of the various topics that you're going through and then communicating back to the vestry, and not just to the vestry. I think it's really important that you get out beyond the vestry into the congregation so that they understand what are the goals of the endowment, how much does it contribute to the operations of the church, and make that, try and not demystify that, so that people understand even though there is this capital that's coming in from the endowment, stewardship, the engagement is incredibly important. So I think there's a lot of variability in the circumstances of the different folks who may be listening today.
Thank you, Joanne. I'm going to share one more question. We have literally 5 minutes left, but I want to make sure, because this has actually been asked by 4 different people in different ways. Donor restricted funds. We have several questions on donor restricted funds. One specifically was inherited. Church inherited a donor restricted fund with no written documentations. Suggestions on direction of moving forward with this. Open question to the panelists.
Well, this comes back, of course, to coordination and documentation. One of the things I was going to add to Karsten and Joanne's very able comments is you need to have, there's often a finance committee of the vestry, there's the investment committee, there's often a development group. Those people need to meet together as a group at least once a year, and you'd be surprised how seldom that occurs. The idea here is you don't have a situation where the finance committee or the vestry says to the endowment, oh, guess what? We need X this year. And the endowment says, whoops, we're not set up for that. So this kind of constant, as it were, organic coordination is very important. But to your point about this, it's not unusual to find yourself in a situation where there is a fund and there are no records left about what the fund was. And the tradition in the church is that the fund is for X and might be possibly repurposed to X plus. This is where Karsten was talking about our friend, the Uniform Prudent Management of Institutional Funds Act, UPMIFA. I was an observer at the drafting of the law. It's a great little law. It applies in every single state in the country except Pennsylvania, which has other laws that are very similar. So we're kind of talking about a thing. And here, the law steps in where there is not that documentation and guides you and says that the intention, absent a gift instrument to the contrary, a written instrument to the contrary, the law implies or assumes that the intention of whatever donor was to create what they call a fund of permanent duration, a perpetual fund, and that needs to be managed with a view to perpetuity, with a view to maintaining the purchasing power, excuse me, of the fund over time, and within the constraints of prudence with respect to investing, spending, and delegating to an agent. And these are all listed in this lovely little law. So I'm agreeing with Karsten. I'm sure Joanne would say the same thing. Get your counsel in, take a look at UPMIFA, make a little minute in the vestry minutes or the committee minutes, and put that in the file with that particular fund, and then you know what to do. And the law will protect you because it wraps you in what's called the business judgment rule, where if you exercise this procedural prudence in considering these factors, then you're absolved from personal responsibility. So it gets you to a very good place. I don't know, anybody else please contribute.
Thank you. Kevin, do you have any final remarks? We are at the end of our session.
Yeah, just, I think Bill hit the nail on the head there. Just, get a legal opinion, document it, put that away as part of your process. And then MIFA kind of, guides you in the right direction in terms of your responsibility. And then just one other comment too, that I wanted to add in terms of, the vestry and the investment committee. We had kind of touched upon, the investment committee may have some, finance people on the committee that understand that more, but diversity within the committees and the vestry is really important as well. So you get different viewpoints, different thoughts, different concerns that can be expressed, and communication obviously between the two is really important.
Thank you. And thank you all for joining us. We are at the end of our panel, and this has just been a fabulous conversation, engaging. We hope you learned what you came here to learn. We're all available to speak further, either by email or phone. Karsten, is there anything you'd like to add as we close?
Not at all. Many thanks to everybody for joining.
Thank you. Thank you so much. Bye-bye.
Bye.